Bitcoin tends to lag somewhere around 10 to 12 weeks behind the money supply. So if you see the money supply expanding over 10 or 12 weeks, Bitcoin's going to catch up to it. And the only way that won't work is if money supply contracts and then it meets Bitcoin somewhere else. But the reality is Bitcoin tracks the money supply, the liquidity supply, global liquidity, very well. And so that's the measure that I like to look at personally, because it includes more than just money. It includes the actual liquidity that's driving the purchase of these assets, whether they're risk assets like the S&P or they're hard monies like gold and Bitcoin. And he groups gold and Bitcoin together in a different section in his newsletters.
Under the surface of the global economy, something concerning is developing, and James Lavish claims it's no coincidence. The pressure is subtly increasing as central banks around the globe tread carefully on a minefield of growing debt and slowing growth. The United States recently surpassed $36 trillion in debt, and interest payments alone are rapidly depleting federal revenue. Lavish, a macro strategist and former hedge fund manager, thinks a new era of financial repression is upon us. Liquidity injections disguised as emergency support, hidden yield curve management, and an increasing reliance on artificial markets are all indicators. The twist is that, although the mainstream narrative discusses soft landings and recovery, Lavish sees something much more structural, including a shift to scarce assets, a slow but inevitable institutional migration into Bitcoin, and a breakdown of trust in fiat systems. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
M2, we've got lots of liquidity. Bitcoin's gonna kind of track, lag behind that a little bit, but sort of track it generally.
A good question. M2 is expanding primarily because of operations out of China. They're expanding their money supply, but that's global M2. I actually do you know Michael Howell? He's got a fantastic newsletter, and he to me is a leading. He's got the leading knowledge base on liquidity, and so it's not just the money supply. He looks at the expansion of global liquidity, and it includes different measures. And this is why it's so important. It's not just the money that's being created; it's the debt that's being created and the amount of leverage that's in the system. And so that's liquidity. And so what he looks at the money, then he looks at things like, all of the debt, and he looks at things like the volatility of bonds. Why would he look at volatility of bonds? And this is all proprietary, what he does. I don't know what his calculation is, but it's fantastic. But what he does is he looks at how you can borrow against assets. And so if you have volatility in debt, and specifically in treasuries are the largest asset class to borrow against, U.S. treasuries. If you have high volatility there, that means that the lenders are going to require higher margin. That means that there's going to be less liquidity because you can borrow less against it to expand the money supply more, right? Does it make sense? So he looks at things like that, and the way he's been looking at it, he thinks that we're going to continue. We have contractions and then expansion, contraction. He thinks, but it's still going up. We're going to expand into the end of this year, early next year, in liquidity is what he's projecting. And that means that, and he plots Bitcoin against this measure of liquidity. And he looks at it and says, hey, Bitcoin tends to lag somewhere around 10 to 12 weeks behind the money supply. So if you see the money supply expanding over 10 or 12 weeks, Bitcoin's going to catch up to it. And the only way that won't work is if money supply contracts and then it meets Bitcoin somewhere else. But the reality is Bitcoin tracks the money supply, the liquidity supply, global liquidity, very well. And so that's the measure that I like to look at personally, because it includes more than just money. It includes the actual liquidity that's driving the purchase of these assets, whether they're risk assets like the S&P or they're their hard monies like gold and Bitcoin. And he groups gold and Bitcoin together in a different section in his newsletters. So you can see that this global liquidity is that it's been expanding. It continues to expand, and that's not just money. You can see it here, and it has to do with the U.S. dollar weakening. Means it's cheaper to buy assets here, so that expands liquidity. You've got treasuries and collateral values are going up, so that's good. So you've got a fall in bond market volatility. That means that you need less collateral for more borrowing, because the volatility means that the lenders will allow you to borrow more because it's not as risky because there's lower volatility. And then if you go down here to the bottom, you can see that here's Bitcoin and global liquidity. And so here's the chart right here. You can see that Bitcoin it tracks it very well. It got ahead of itself here, and then it came back, and now it's been tracking it really closely ever since. Now we know that this number is going up, and that we expect that Bitcoin is going to follow it. And so that's because this is a current number, and it's actually this is lagged, right? So it's actually been it's expanded since then. So that's kind of the way that's how I look at it, and that's why I think I agree with you. It's very important to look at liquidity. People typically use M2, but I think that's the largest aspect of liquidity. Clearly, that's the largest piece of what he looks at, like by far. But there's other factors in there, and so I think it's a closer approximation to what's really going on in liquidity, as opposed to just the money supply.
Central banks are not the only factor contributing to the rapid increase in global liquidity. A calmer bond market, increased systemic leverage, and rising debt levels are all contributing significantly to the surge. Lenders become more at ease when U.S. Treasury yields become less volatile. This enables borrowers to obtain more credit by using a larger portion of their assets as collateral. Furthermore, as credit expands, more money enters the system, supporting riskier assets like gold, stocks, and yes, Bitcoin. When inflation increases or fiat currencies depreciate, investors in this type of environment begin to seek out tangible assets that retain value. Bitcoin and gold are typically the most popular choices. Bitcoin, however, acts somewhat differently. It typically responds to shifts in global liquidity quickly, often only a few months later. Depending on the macro environment, it can play a variety of roles, ranging from high-risk asset to safe haven. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content before we go any further. Now, let's get into his powerful predictions.
But the second thing is it never closes. So if I'm a hedge fund manager, which I am, but if I'm a hedge fund manager that operates in dollars, my hedge fund is on a Bitcoin standard, so this is not the case for me. But if I was in my old hedge fund and we had a position, let's say that we had a large position in Bitcoin, and it was just a speculative position for us, like it would be for gold or whatever, that it was, we're speculating that this is going to happen in the economy, or this is what's going to happen in the money supply and liquidity, whatever. If something occurs over the weekend, let's say that Iran is bombed, for instance.
Hypothetically.
You're sitting there on a Saturday, you're a hedge fund manager, your kids are playing in the pool, you're at the kid's birthday party, and you see this, and you're like, oh my God, what am I going to do between now and Monday morning at 9:30 Eastern time? I've got until between now and then to figure out what my risks are in my portfolio and how I can shore them up. What are they worried about? They're worried about a drawdown in the total market, right? That will cause some of their positions to require higher margin because of what we talked about, volatility. So what prime bankers will do is they'll change the margin requirements, where now they're saying, well, you need this much margin to change the rules on you. And then and this has happened to me before, and then you've got to decide what you want to sell to meet those margin requirements, because typically hedge funds are operating on at the minimum, they're operating on what's called Reg T, which is 50% margin, typically. And some hedge funds have something where it's called portfolio margining, where you can get up to all the way up to just a 6 or 7% haircut on your positions, meaning that you can borrow 93% of it. Okay, so, and those haircuts can double overnight, triple, quadruple. Ours quadrupled in March of 2020. So on big names, big bellwether names. So that's what he's staring down, and he's sitting there on Saturday or Sunday morning. He's like, I'm going to have margin calls. I know I am, because the market is looking like it's going to be down 5 or 10%. Oh my God, it's a crash. What can I do? I can sell one thing. I've got one asset in my portfolio that I can sell, and it's Bitcoin, because it trades 24/7 on these exchanges. And so that's why you see Bitcoin rip around on these announcements sometimes, because it's the only thing they've got in their portfolio they can actually sell on the weekend and get liquidity ahead of that problem. Because when they walk in Monday morning, they're not going to say, oh, well, let's sell a little bit of this, let's sell a little bit of this. They're going to say, sell 10% of everything across the board. And that's why everything correlates to one. They're like, just get me out of 10% of everything. I need cash to manage, to make sure that I'm in the right position here.
According to James Lavish, Bitcoin responds to more fundamental forces in the financial system rather than moving at random. He notes that although the majority of people observe simple money supply charts such as M2, they frequently fail to see the wider picture. The amount of money that can be borrowed, the stability of the bond markets, and the level of confidence in the financial system overall are all factors that contribute to true global liquidity, not just the amount of money that is printed. And the amount of money that flows into assets like Bitcoin is influenced by all of these factors. An increase in global liquidity indicates that borrowing is simpler, volatility is low, and capital is flowing freely. Usually with a slight lag, Bitcoin tends to follow that pattern. Even though Bitcoin appears volatile in the short term, data indicates that it closely tracks global liquidity, so this isn't just a guess. According to Lavish, this is one of the most crucial markers for forecasting the future movement of the price of Bitcoin. But his message is more profound than the charts. Many people feel helpless in a world where governments can carelessly spend billions of dollars or accrue unmanageable debt without being held accountable. Assuming there is no escape, they relinquish the notion of self-sovereignty. Institutional investors are also starting to recognize this. What was once written off as a fringe, risky asset is now being recognized as a real store of value, similar to gold but more transparent, mobile, and digital. Therefore, even though Bitcoin may still occasionally behave like a volatile risk asset, it is increasingly evident that it is a tangible asset with global significance, particularly as financial systems grow more unstable. And that's where the real story starts. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.